A Bala joining us this morning. Bala, great to have you with us as always. What's your sense, Bala, going ahead from here in the near term? What are markets really watching out for? Is it or are the growth concerns weighing heavy on markets right now, or is it more that they're waiting and watching for some near-term cues?
Yeah. Of course, the market is paying attention to the recent slowdown that we are witnessing on the auto sector. I think auto sectors, I'm seeing after a very long time, have announced a shutdown of plant, moving away from 3-shift working to a 2-shift kind of working, and inventory levels have gone up quite significantly as statements given by most of the auto manufacturing companies. That something is actually bothering more from the point of view of the kind of GDP growth that which was being expected. We will probably see some bit of slowdown. And second is, of course, some of these auto inventories also is coming from the fact that I think India is moving towards BS6. Therefore, they have to prepare for BS6. That inventory level building up and need to get cleared before it gets introduced. Apart from that, one of course is how the monsoon is going to play out. Despite Reserve Bank of India giving a rate cut last week by almost 25 basis points, and they have changed the stance to accommodative. And despite that, there are fears about the monsoon. If it's not up to the mark, then how it could have an impact on the agriculture output, therefore on the inflation, so on and so forth. The liquidity is good. Interest rates are favorable, but clearly some of the macro indicators are not pointing towards the better GDP number. Then naturally, in this kind of context, how the budget will be presented, which is on 4th July. So I think market is actually waiting for some kind of cue to come from the budget, which I think hopefully I think should drive the sentiment for the next few months. But one thing remains constant. I think post-election results, there is definitely an uptick on the optimism. There is a hope, of course, now is coming back, and foreign investors are looking at more favorable India, and not for 1 month, 3 months, 6 months. I think they are looking at beyond year, and maybe they are looking at 5 year, even beyond for that matter. Therefore, allocation towards India from emerging market to the emerging market, especially in India, I think from foreign investors have been rising. And second is some of the deals which were actually trying to get closed before the election outcome, and now they are all now coming back into pursuing those transactions. I'm talking about FDIs, investments, nature in some of the sectors like roads and few other assets. I think there is a renewed interest that is coming back for India.
Yes. And in continuation with that, Bala, it was so heartening to see the latest AMFI data. For a second consecutive month, we have seen inflows come by. And especially what's staggering to note is the kind of inflows that one has seen in small as well as mid-cap funds. So mid-cap funds have notched up a good 160% on a month-on-month basis, and small-cap fund inflows are up nearly 50%. Do you think this is a telltale sign that maybe in the times to come, Bala, could we see a bigger recovery when it comes to the broader markets as opposed to the large caps? Because the last 1.5 years, it was about large caps, while the mid caps and small caps were completely beaten down. Now could we see this revival and reversal coming in?
Yeah, of course, obviously that optimism is coming back for generally I call it as a rest of Nifty, a rest of Sensex, kind of stocks which are underperforming for the last 1.5 years. That's something I think in our view will come back. And second, one of the data points that we are looking at, the Sensex is an all-time high post-election outcome result. Nifty is an all-time high. I think all of us are seeing that. And clearly, if you look at the two indices, which is mid-cap index and the small-cap index, they are still trading at about 16% lower than the peak at which they touched. So that means they are lower still to the peak index that they touched, and therefore still a long way to go. And second is the whole interest rate cut environment that we are seeing. I think easy liquidity, easy interest rate scenario has to benefit the large pool of companies coming from the mid and small cap space. And therefore, the optimism coming back towards India. And now we have seen a significant outperformance that we have seen coming from the large cap indices, such as Nifty. Therefore, that is putting the valuations a little high. As a result of that, the valuation which I think was the question mark in the mid and small cap companies in the past, Now it got corrected, and therefore, I think probably we'll see the next 3-4 years mid and small cap companies do much better. Ultimately, everything will boil down to stock specific, sector specific, but so clearly I think there is a trend that is emerging that segment I think will move up. That's why we have seen inflows for the mutual funds close to about 5,500 crores in the month of May. It's better than April. It's better than the trend that we have been seeing. And again, coming the fact that it's coming in the mid and small cap space, that essentially means that people are willing to now take a bet with the clear 3 to 5 years kind of time frame.
When it comes to asset allocation, Bala, would you say that maybe now is the time to make a larger exposure and larger allocation to perhaps mid and small cap funds as opposed to the balanced category which was most favored almost for a year now?
Yeah, I think clearly the point that I mentioned about earlier, where the interest rates are close to about 10-year bond is about 7, and the corporate bond yields for AAA corporates now is close to about 7.80, 7.8, and probably we'll see some more rate cut will bring down the rates further, which essentially means one has to go for growth, one has to go for pure equity, and naturally the mid and small cap space, given the fact they are valuation wise they are relatively better than large cap names, and any uptick that could come on the earnings actually will come faster actually in that segment. Therefore, it makes a lot of sense actually to move into that segment. I think balance advantage kind of category is more for conservative investors, especially when the interest rates are at the mid single digit level. Naturally, one should expect a relatively not so better outcome, though it can protect your downside, there is absolutely no doubt. But since we are looking at high optimism kind of scenario, it makes sense actually to have a higher allocation towards mid and small cap names.
Good to hear that, Bala, and coming from you, I'm sure all our retail investors would really, take a note of that advice. But what about debt funds, Bala? And especially, the recent history and the instances which have come in have really left a very bitter taste in, the retail participants' hands. Would you say that have a balanced approach again when it comes to both debt and equity allocation, because the recent past has told us that even debt investments are not really foolproof and they do come in with extremely high risks of their own?
Yeah, I think clearly the point what you made is very clear. Of course, no one single investment gives you a linear return continuously year after year, and that's why I think asset allocation plays a very key role. I always believe in one should stay with about 50-50 kind of formula, 50% towards equity, 50% towards debt. There's absolutely no doubt in the last 6-7 months since ILFS crisis happened in the month of September, the credit noise levels have been in the industry has been quite high. But again, I always say that it's blown out of proportions given the fact the industry size is about pretty large. The issue that you are talking about, whether it is ILFS, whether it is some of the other credit names that has been coming, I think in relation to the overall the issue that we are discussing about is small. And second, the fixed income, I think everyone has to understand that the fixed income has got 3 components on calculation of NAV. The largest component of fixed income NAV movement come from interest accrual, which is nothing but interest credit that we get. That actually drives the largest proportion of the NAV movement. And that's being the case, whatever the credit loss that will come, the credit downgrades, therefore you actually have mark to market losses, and those actually are more of temporary nature. Some recovery will come, maybe we'll have less recovery, but at the end of the day, I think if you stay invested for 3 to 5 year period, it does definitely give a better experience, and that's something I think one should keep in mind. There absolutely no doubt there is a general negativism that got set in. In my view, is absolutely one should ignore that. And given the fact that the loss given ratio in fixed income at the worst case scenario would be about 20%, that 20% or 20% is going to come from only some portion of the portfolio, is not going to come from the 100% of the portfolio. So therefore, one should stay confident on even allocating their some bit of money towards fixed income as well to have the right balance between equity and debt.
Sure. Bala, you spoke about, the budget and the countdown a little earlier. I must ask if there's anything specific that you'd like to see or anything that you're hoping to hear from the finance minister this time.
Naturally, of course, a lot of expectations get built up pre-election, but this time I assume the interim budget which they presented, they have addressed some of those issues about simplifying the tax structure for people who are less than 5 lakh rupees. I would assume the budget would address and give a clear roadmap towards the direct tax revamp. Direct reforms, I think, is a must. I think giving more money in the hands of middle class income population, let us say up to 10 lakh rupees salary income earners, give more money in the hands of them in the form of tax cut that can actually potentially lift the whole consumption, which is lagging behind currently. And second is there is a need for giving some kind of more incentive certain sectors like even real estate. At the end of the day, the issue that is facing the industry both on real estate as well as on auto industry is about inventory build-up. So there has to be some actually push that needs to be given, even if it is a clear time-bound kind of inventory clearance system if we are able to create. Then it helps in reducing the inventory level. Therefore, I think the new pickup that could happen on new construction and so on and so forth. I think giving some kind of soft to the real estate sectors, naturally it benefits the other allied sectors in the same space. That's something which I wrote also some piece some time back. So I believe some of those stuff I think will definitely help in actually driving the economy to the next level as we move forward.
Okay, so just before we let you go, Bala, I must ask you one question on valuations as well. Given where we are trading right now, do you feel, that we will see some kind of correction in the near term before perhaps resuming momentum, or do you feel relatively, especially when it comes to broader markets, we're actually fairly placed and will continue to now see a lot of opportunity?
I think the way we see is there is no doubt that valuations have become a little costly for the Sensex and Nifty as a whole. Definitely they get advantage of the foreign flows and optimism that came back. Therefore, I think overall market is holding back. At the same time, our belief is the earnings I think will probably start coming in the third and fourth quarter onwards. Once the budget is over and the government start pushing in some of their government spending, and therefore that I think should lead to some kind of pickup in terms of earnings. And second is the interest rate cut that has come. So far, it's not been fully transmitted to the borrowers' point of view. Probably after a period of say 1 or 2 quarters, the banks will be forced to cut the rates, and that is the time I think the earnings led by interest rate cut will also start accruing to the companies. Therefore, it's just a catch-up game at this point of time. What is holding the market up is about the optimism and also the flows, and that should naturally get converted into the earnings as we move forward. I think ultimately it's come back to the stock specific and sector specific, which all of us do play an important attention to that space to construct our portfolio.
Thanks so much for joining us this morning, Bala. Always a pleasure. Good to have you with us.